Welcome back to the channel, everyone. Today I want to talk about the giant pension fund that's just bought some more AMC. And there's also something absolutely incredible going on with the GameStop short interest. Obviously, I want to tell you what's actually going on and also how this impacts GameStop and AMC. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, a giant US pension fund bought more AMC, Snowflake and Tilray stock, and it also sold some stocks too, including Berkshire Hathaway. The second largest public pension fund by assets in the US increased its stake in one of this year's most volatile stocks, initiated a position in a marijuana grower, and trimmed its exposure to Warren Buffett. The California State Teachers Retirement System bought more shares of movie theater chain AMC, and analytics software firm Snowflake. It also acquired some shares in the cannabis producer Tilray and obviously reduced its holdings in Berkshire Hathaway. CAL-STRS bought 133,000 more shares of AMC to end the third quarter with a whopping 689,917 shares. AMC's stock price rocketed nearly 19-fold in the first 9 months of the year, and so far in the fourth quarter, shares are down 1%. For comparison, the S&P 500 has gained 6.7% so far in the fourth quarter. Therefore, it seems obviously weird upon initial impression that this giant pension fund would be buying more AMC instead of the S&P 500. But obviously that's because people like you and I know that AMC is going to squeeze. It may not be tomorrow, it may not be the day after, but the squeeze is inevitable. They said that AMC stock caught fire during the meme stock frenzy earlier in the year, when small investors communicating via social media bought shares of beaten down companies in hopes of triggering gains that would force people who'd bet against those stocks to buy in order to close their bets. The trend led to a surge in volatility that prompted the Federal Reserve to warn this month that meme stock related market swings could be a risk to the financial system. And therefore it's not just the Fed that sees more volatility or squeezing in the meme stocks, but clearly one of the second largest pension funds in the United States sees the exact same thing happening again. AMC's third quarter results were better than expected, and the chain is now accepting cryptocurrencies for online payments as well as issuing new NFTs. The pension fund sold 511,000 shares of Berkshire Hathaway. Those shares rose 18% in the first 9 months of the year, and so far in the fourth quarter, they've gained 3.7%. Therefore, again, at the moment, Berkshire Hathaway is outpacing AMC with its negative 1%, but obviously AMC is going to squeeze sometime in the future. We can see here from the 13F filing that they now hold 689,000 shares, worth a whopping $26.25 million. Now obviously this is very, very interesting because not only have a supposedly very low risk pension fund bought more AMC, but also they've averaged up their holdings of AMC. Obviously the pension fund previously bought into AMC around the low 30s area. Obviously this is the quarter 3 filing, meaning that they bought more AMC at the $40 and $50 region. Therefore, clearly this very risk-averse pension system believes that AMC is undoubtedly going higher, and that's why they're buying more shares. MORE are currently holding their biggest ever promotion, currently giving away 5 free stocks valued up to $3,500 each. So I wanted to break down how you can get every single one of these free stocks. When you open your MORE account, you get your first free stock valued up to $3,500. When you deposit any amount, even if it's only $1, you get your second free stock also valued up to $3,500. And if you can deposit $2,000, then you get the final 3 free stocks, also valued up to $3,500 each. So that's potentially up to $17,500 in free stocks that you can get just for signing up with MORE, opening your account, and making your first deposit using the link in the description below. Now I also wanted to talk about a potential another reason why Adam Aron issued 86,000 SpiderMan NFTs. This guy tweeted saying, could the 86,000 NFTs be in reference to Spider-Man copy number 86, where he eliminates a fake copy of himself? As you can see here, issue number 86 of Spider-Man is him defeating a female copy of himself. Therefore, maybe this is a sign that Adam Aaron is trying to defeat the fake copies of the AMC shares or the synthetic shares. Now, why I think the NFTs are such a big deal for AMC and for Adam Aaron is because it now gives him a plausible business reason to effectively announce this next potential tweet. Adam Aaron now has a legitimate reason to tweet something like, due to the high demand of trying to get the SpiderMan NFT and so many people not being able to get in and get one, and the disappointment from that, I'm now offering one NFT for each shareholder of AMC, or one NFT for each share we've ever issued. I think this is a bold step that Adam Aaron took, but it's absolutely paid off both for him and for AMC as a company, as I'm sure they generated record-breaking sales during that period of yesterday and today. Now, I also wanted to talk about Ken Griffin's Citadel being a leader in leverage. Obviously, yes, first thing you'll notice is that this article is from a long time ago, but I also have the figures to update this article to what it should be right now. So this article starts by saying Chicago-based Citadel appears to be the most leveraged of the 25 biggest US hedge funds, with an implied leverage of about 8.8 times investment capital. Back in 2014, Citadel had $142 billion in regulatory assets under management as of March 31st, but according to the annual filings with the SEC, it only had $16.1 billion in investment capital. Now, as a 2021 update, they have $35 billion in investment capital and $235 billion in assets under management, giving them a ratio of around 6.8 times. To compare that to Bridgewater Associates, they only have a moderate leverage ratio of 2.3 times capital. So obviously, a lot of hedge funds out there like BlackRock and Vanguard are using much smaller, more sensible leverage ratios. But obviously you've got funds out there like Archegos Capital Management and Citadel that use much more reckless, risky leverage ratios. As this article says, leverage or borrowing ramps returns on the way up, but can equally amplify losses on the way down. Some hedge funds have boosted leverage recently because debt is cheap and markets have been soaring. Leverage is always a worry, and an 8.8 times blunt figure would raise anyone's eyebrows, said a long-term investor in Citadel's funds. But he said he was comforted by Citadel's excellent risk management. Now, maybe in 2014 Citadel did have excellent risk management, but they definitely do not have excellent risk management now in 2021, having doubled down, tripled down and quadrupled down on their naked short of AMC. If you have a look at some of Citadel's largest positions, they have $33 billion of S&P 500 puts and around $19 billion of Tesla puts. Bear in mind, they've held those put positions over the last 3 months, the last 6 months, and maybe even the last 9 months as well, maybe even longer. Obviously, I know it says quarter first owned here was in 2010 and 2014, but obviously they've added substantially to their puts since then. Now, obviously, if you rewind to the last 6 to 9 months, having put options on the S&P 500 and having put options on Tesla hasn't served them very well. Tesla obviously ran from around $630, $650 all the way up to $1,200 per share. And obviously over the last 6 to 9 months, the S&P 500 has also basically been on a massive tear. Yes, it's had a few small pullbacks, but nothing major, and is obviously much higher than it was 6 to 9 months ago. And therefore, it really wouldn't surprise me if Citadel are getting very close to the edge. Citadel's killer leverage last came under scrutiny in 2008, when it had to unwind a leverage of 8.2 times as the financial crisis unfolded. Obviously back then, Citadel's hedge fund lost 55% that year and took years to recover. It wouldn't surprise me if Citadel are taking on heavy losses between their AMC shorts and also their Tesla shorts and their S&P 500 shorts. Now, I also wanted to touch on and talk about the box office figures for 2021 compared to pre-pandemic eras of 2019, 2018 and the years previously. This year for 2021, the box office has currently done over $1 billion in sales. This also doesn't include December, So I'd expect it to do at least 1.2 billion, maybe 1.3 to 1.4 billion because of the release of Spider-Man, The Matrix, and a few other great films. Now, this is obviously lower than what we're seeing in 2019 and 2018 with 1.5 billion, 1.8 billion, and so on in the years previously. But something I think is hugely important is the number of films made this year compared to previous years. In 2021, they've only released 120 films. 2019, 290 films, and 2018, 311 films. That means the average income or average revenue per film released is $8.8 million for this year in 2021, but historically that's only been 5.2 million, 5.8 million, 5.1 million, maybe 6.3 million at the highest. And therefore the average income per film is absolutely massive this year compared to previous years. If we'd released 200 to 300 films this year, this figure would be 2 billion, 3 billion, maybe even $4 billion from the box office. I think this is a massive step in the right direction. As vaccines are increasing day by day, we should see many more films being released in 2022. Maybe we'll get back to over 200 films being released per year. Therefore, in 2022, I expect to see this figure for the box office touching $2 to $3 billion. Now, I also wanted to talk about some massive developments in the GameStop short interest. The GameStop short position is back to where it was pre-January 27th. It looks like all of those shorts hidden in the option chain and swaps were found and potentially now are being forced to be reported. You can see here the short position in billions of dollars has increased back to $70 billion. Previously, for many months now, it's been sat only at around $10 billion. The days to cover has also jumped massively from around 5 days to cover, maybe 2 to 5 days to cover, all the way up to a whopping 30 days to cover. This data is pulling from Thomson One. Now you might say, well, I haven't really heard of Thomson One. Is that affiliated with Thomson Reuters? I'm not too sure. Are there any other sources that also confirm this data? Well, you've also got Fintel here. You can't see the actual Fintel at the top of the screen, but this is a screenshot from Fintel showing the short percentage is over 100% again. GameStop is currently being shorted 113%. And you've also got another source here, again showing the short position has increased back up here where it was back in January. So therefore you've got 3 separate sources all reporting an absolutely massive increase in the GameStop short position. You can see the actual number of shorted shares has increased from around 7 to 8 million shares, all the way back up to around 71 million shares. This is very, very interesting, whether these funds are now being forced to report their actual true short positions, or maybe there are some funds that have just taken out massive short positions on GameStop and have really pushed up that short interest again. I guess we'll soon be seeing over the coming few days how this unfolds into the market, whether this is some kind of data error across multiple platforms that gets fixed or changed, or whether GameStop the price starts running up again. And finally, I wanted to quickly touch on Fantasia and how Fantasia is now formally being liquidated. Chinese real estate developer Fantasia, which failed to repay $206 million worth of bonds last month, has now announced that one of its key subsidiaries has received a formal winding up petition. And it's also not just Fantasia. A similar case is also currently underway against Evergrande, with Shanghai Trend Zone Holdings filing a lawsuit against Evergrande in mainland China. So it's not just Dr. Marco Meltzer filing lawsuits against Evergrande, but it's also Chinese companies now also filing lawsuits against Evergrande. And therefore I don't think it will be long before Evergrande and many other Chinese property developers are also receiving formal winding up petitions. Guys, be sure to let me know down in the comments below what you think about the second largest pension fund buying MORE AMC, and what you think about this massive change in the GameStop short interest. And if you haven't already, be sure to sign up to Moomoo to get those 5 free stocks valued up to $3,500 each. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.